it is a fair question to ask whether tariffs can be the primary driving force behind a second wave of inflation, which would completely change our trading strategy. On the surface, it's true that tariffs do raise consumer prices. Remember, a tariff is a tax on an imported good, and so they're paid for by the company that imports these goods. So in this case, American firms. The company paying the tariff has a few options. They can absorb the cost, which reduces their profit margin. They can pass the cost on to consumers by raising their price, so causing inflation. Or they can try and rejig their supply chain, find a local manufacturer, which is generally a deeply costly process. So these all constitute a cost for either the consumer or the company. So chances are that at least part of the cost of tariffs is going to be reflected in higher consumer prices. For example, in 2018, Trump imposed a 20% tariff on washing machines that were imported from China, and eventually raised these tariffs to 50%. If we look at the price of washing machines in the US, we see they immediately jumped by about 12% when the tariff came into effect. Academic research suggests that for every percentage point increase in the effective US tariff rate, consumer prices will rise by 0.1%. So given Donald Trump is getting ready to raise tariffs by 15%, that would mean around a 1.5% increase in consumer prices in that scenario. But that would be just a one-off price increase. Real inflation is spread out over time. It's when consumer prices rise month after month, and there is simply no evidence that tariffs could cause this kind of prolonged rise in inflation. In fact, we can see this just by looking at what happened to inflation during the trade war under Donald Trump's first term. There was an initial jump in inflation, but it quickly came back down to 2% around the Federal Reserve's target. Of course, the size of Donald Trump's tariffs this time around are shaping up to be much bigger and much more widespread than anything we saw during the first trade war. But when we zoom out to the last 100 years of inflation data, and we add the average US tariff rate on top, we see that in the 1930s, tariffs were also exceptionally high, and this was definitely not a period marked by inflation. Quite the opposite, actually. The 1930s saw severe deflation. So we think that this narrative around tariffs potentially fueling another wave of inflation is overblown. While tariffs do mechanically impact consumer prices, they don't necessarily lead to structurally higher inflation. And again, that's pretty good news for stocks. Low inflation is one of the key drivers behind today's stock market bull run, and it does not seem that tariffs are going to reverse that in a big way.